Hello, my friends. Today is October 28th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we have to talk about the 10-year yield. Now, we've been discussing this subject on and off for the past few months. But today, I'm going to say something a bit different. I think that the highs for the 10-year yield for this year are probably in. And I'll tell you why I think that. Secondly, I want to talk about gold. So this past week, we had stock sell-off, we had bond sell-off. It looks like everything in the financial markets was a disaster, with the exception of gold, which basically took off like a rocket ship. It seems like gold is getting a very strong safe haven bid. Let's think about some of the drivers behind it. And lastly, we have to talk about the bonkers GDP print we had the past week, where third quarter GDP in the US printed at an annual growth rate of 4.9%. Not too long ago, there were so many doomers all over social media telling everyone that at any moment now, the economy was going to turn a corner and you're going to get a recession and so forth. And the economy did turn a corner, but it turned upward. Let's see if that's sustainable. Okay, starting with the 10-year yield. Now, before we proceed, let's level set a little bit. Taking a step back, we can see that the 10-year yield started the year a bit below 4% and throughout the year steadily trended higher. No surprise to any of you. Now, when we crossed 4.3%, I told you guys that the highs were not yet in for the year. When we crossed 4.5%, I said the same thing. But I think there are a few things changing right now that lead me to think that we may be due for a pause, at least for the next few weeks until the end of the year. Now, make no mistake, as I've been saying for the past 2 years, I believe that the future will not look like the past. We are in a world where interest rates will trend structurally higher. From my own work, I look at this from the perspective of supply and demand. And as we know, supply is, for all intents and purposes, infinite. The US government likes to spend money, and it's going to spend more and more money going forward. From my work on the financial system, I don't think that the financial system is elastic enough to absorb all that issuance unless yields go higher. And of course, there is a chance where they can spike higher. The end game for all of this is, in my view, some sort of active involvement from the Fed, maybe in the form of yield curve control. That is the inescapable end game. But like a movie or a novel or anything like that, you don't go straight away to the ending and fight the boss. There's a journey, a process. Now let's take a big zoom back and look at the tremendous bull market in treasuries over the past few decades. We can see that yields trended lower over decades, but it wasn't a straight line. Every now and then, we'd see yields jump higher before resuming their trend downwards. Now, this is true for basically any financial asset. And so over the past year, we've seen yields rise significantly. So I think it's reasonable for us to have a bit of a pullback. But there are three specific reasons for it. First off, as you recall, on Monday, when the 10-year yield traded briefly above 5% and then retreated below, we saw some big personalities in social media come out and say, guys, I think the yields are too high. There's recession and geopolitical risk and so forth. And I think those guys, they are, obviously influential, but I think they are indicative of sentiment broadly. We've had a big move upwards, and I think perhaps the market could use some time to digest. Secondly, if you've been following my work, my sense is that over the past few weeks, there's been a shift in monetary policy. Now, monetary policy is like a super tanker. It moves slowly and deliberately. And my read is that the Fed has subtly shifted, whereas in my view, the rate hiking cycle is most likely over. And I think that the market is misunderstanding how things will play out. Now, recall, over the past 2 years, I've been telling everyone that the Fed is going to hike rates a lot and they're going to stay higher for longer. The market has been fighting that for the past 2 years and has been totally wrong all the way. Over the past few weeks, though, the market is pretty much in line with what the Fed has been projecting in their dot plots. Let's say the Fed hikes rates maybe one more time, but then holds it for extended period of time. What the market is not yet understanding, I think, is this shift that we've been hearing from some members of the Fed, where because the 10-year yield has risen up so much, there's less of a need to tighten. And if you look at recent data, you can see that inflation is very much trending in the right direction. So I suspect that we'll probably get rate cuts in as early as March, and which is not what the market is pricing. So I think the market is making the same mistake it did in the past, and that is to say, thinking that the future looks like the past. And if monetary policy really does shift, and I think it will be more obvious in the coming weeks that there has been a change in the stance of policy, then that would put downward pressure across the curve, across the interest rate curve. Now, the last thing that I'm thinking that would contribute to slowing down this steady rise in yields is that I suspect that the US Treasury is probably going to have to do something to stabilize the markets. Now, the US Treasury gets to decide where along the curve they issue Treasury debt. And this power, this discretion, gives them the power to impact financial conditions. For example, they could choose to issue a whole ton of 10-year, 30 years, and that would definitely make yields shoot up higher, which will make financial assets be unhappy, and it will make mortgage rates go higher and would have a negative impact on the economy. Now, they don't have control over how much debt to issue. That's totally up to Congress, which decides spending and taxing. But this power to adjust issuance along the curve is important because the US Treasury could, for example, decide to issue a lot more debt in Treasury bills, where there is tremendous demand for bills in the markets. So if you issue a whole bunch of bills, it's not going to have a big impact on longer dated yields or market prices in general. So the last quarter, the US Treasury decided that they're going to slightly adjust the share of bills they issue higher than they usually do. And I suspect that they're going to continue to do that because that's the only way. Well, it's not the only way, but because they have an election next year and they don't want yields to continue to rise, putting downward pressure on the economy and financial assets, that's a bad place to be in an election year. So I don't know for this for sure, but from my read, I think that's likely going forward. We'll find out more when they release their debt issuance plan next week. But if that's the case, though, I think that's going to put a bit more stability in the Treasury market. On that topic, we also had a pretty interesting interview from US Treasury Secretary Yellen this past week on her thoughts on why yields are rising. Let's listen to what she has to say.
Largely, I think it's a reflection of the resilience that people are seeing in the U.S. economy, that we're not having a recession, that consumer spending and demand continue to be strong. The economy is continuing to show tremendous robustness.
Okay, so obviously she's saying that yields are going higher because I'm doing a really good job. The economy is booming. I'm sure she has to say something like that, but that's not an unreasonable perspective. U.S. nominal GDP growth is quite strong, as is real GDP growth. So if you're a traditional economist, as she is, you would think there's a connection between interest rates and economic growth. Which brings us to our next topic, GDP growth. So this past week, we had latest GDP data for third quarter US GDP growth, which clocked in at 4.9% annual rate. Now, 4.9% obviously is spectacular. Now, not too long ago, we got doomers just all over social media telling everyone that recession was coming, and the exact opposite happened. Now, for context, for the first 2 quarters of this year, US GDP grew at 2% annual rate. And the Fed thinks that the underlying trend growth for the US economy is 1.8%. So we've been growing above trend for most of the year and seem to be accelerating a bit. Now, there is some concern over this because traditionally thinking, when you think about this, if you have really strong economic growth, that is upward pressure on inflation. We had the latest inflation numbers this past Friday. It continues to show that inflation is trending in the right direction, but we did have a slight tick up in core PCE month over month. Core PCE month over month printed at 0.3%. If you look at the chart here, you know that it needs to get to about 0.15% month over month for the Fed to be back towards target. Again, definitely trending there, but not there yet. However, as we noted, financial conditions have tightened a lot through the 10-year yield rising, and so in the coming months, we may see more economic weakness. Now, one thing I'll note is that there are commentators looking at this print and saying, a lot of this print is because of government, right? Government has been spending a lot of money and that's been goosing GDP. I think that's fair, but I think it's also fair to note that the government will continue to spend enormous amounts of money. There's prospect of even more spending related to potential war. And so, this kind of boosting of GDP through government spending could continue. So that's the past, though. What are we thinking about this quarter, fourth quarter GDP? Now, of course, we've only had 1 month of data so far. There's 2 more months to go in the quarter. But let's look at the GDP nowcast from the Atlanta Fed and the New York Fed. Now, the Atlanta Fed and the New York Fed are both forecasting. So far, of course, we have 2 more months to go, a lot more data to come. But so far, it looks like GDP for the fourth quarter of this year is going to be around 2%. So it's going to be pretty solid as well. There doesn't seem to be the prospect of recession. Now, to be perfectly clear, now the economy goes in cycles. We are always heading into a recession. So eventually, of course, the doomers will be right after being wrong for a very long time. Broken clock, is right twice a day. However, it doesn't look like it's going to be happening in the next few months. I would say that as yields stay high around here, I think I can see that having a big material impact on the real economy. So we could have the economy slow down, let's say second half of next year or something like that. But my own view is that because the amount of deficit spending is so large, it's hard to see the US economy go into a serious recession. And even if there was a serious recession, I think that we'd cut rates, we'd have big fiscal spending, and so forth. The policy response would be strong because the lesson we learned from 2020 is that it works, even if it has inflationary side effects. Okay, the last topic I want to talk about is gold. So this past week, we had gold prices basically shoot up like a rocket ship. Gold ended the week above $2,000, which I think to many people was perceived to be a psychological barrier. Now, when we think about gold prices, I think there are a couple popular stories in the market. One popular story, of course, is real yields. The thinking is that when we had real yields negative, well, if you bought bonds, you were basically burning money. Might as well buy real assets like gold. And so the thinking was that, as real interest rates go higher, that would be negative for gold prices. But of course, over the past few months, real yields gone steadily higher, gold prices gone to the moon. So that has been a very good story. Another way people think about this is to look at gold as another currency. So when the dollar strengthens, for example, then gold prices in dollar terms decline. But over the past week, we saw the dollar very, very modestly strengthen, hasn't really done that much, but gold prices go to the moon. What seems to be driving gold prices, of course, is geopolitics. It seems like, usually when you have big stress in the world, there's a flight to safety. Usually that's into the dollar, usually that's into treasuries. Strangely, that's not really happening so far. But we do seem to have a notable flight into gold. Now, I would also note that this is happening in the broader tectonic geopolitical shifts that are more of a medium-term story. That is to say that there seems to be some more geopolitical realignment in the world. As many commentators have noted over the past couple years since the war in Ukraine, when the Western powers confiscated the reserves of Russia, that a lot of countries that are not friendly with the U.S. are going to be more cautious. Maybe they don't want to hold as many of their reserves in dollars since it could be confiscated. Now we have this big geopolitical struggle in the Middle East where battle lines seem to be formed, where you have the West and when you have the US and you have the European Union basically standing on the side of Israel, and you have the rest of the world standing on the side of Palestine. Now, I don't know how this will eventually evolve into, but there's a potential for some more extended conflict. Now, if you are someone like China or someone, say, in a Middle Eastern country, you probably don't want to have a lot of your reserves held in dollars because, in the event that the US really has to stand up uh, against the rest of the world, well, maybe the US tries to punish the people who are standing against it by confiscating its reserves like they did in the case of Russia. So I would imagine that there's some geopolitical considerations here for the big sovereign countries that maybe they might have to just kind of maybe rebalance a little bit in light of this potential. Yeah, I mean, you don't want war to break out, suddenly find yourself without foreign reserves. That would be very inconvenient. In a related note, I'd also note that Bitcoin this past week also soared. Bitcoin is often thought of as digital gold, but this rise in Bitcoin prices doesn't seem to be related to geopolitical considerations. It seems to be more related to the prospect of the SEC approving a Bitcoin ETF. Now, the thinking is that if you have a Bitcoin ETF, there's going to be more demand for Bitcoin. A lot of retail investors will be able to easily go to their broker, just click buy and buy Bitcoin through an ETF. As more demand comes in, well, maybe that will send prices to the moon. I think that's totally reasonable, and it would make sense to front run this. But I would also note, though, that as some commentators on Twitter have noted, you've had Bitcoin ETFs in other countries like Canada, doesn't seem to have done much. Oh, and one more thing I would note about gold prices is that, so gold, if you look back to the Russia-Ukraine conflict, gold skyrocketed at the eve of the conflict, and over the following weeks gave that all back. So it's really hard to know if this is just a one-time pop, or really is this the mark of the greater, broader shift that many have been speculating on over the past 2 years. We'll find out in the coming months. And okay, that's all I prepared for this week. This week we have an FOMC meeting, so I will be here to give you my thoughts on what I expect to be an uneventful meeting. And again, if you're interested in hearing more about my latest market thoughts, check out my blog at fedguy.com. And if you're interested in learning more about macro assets, check out my online courses at centralbanking101.com. Talk to you all soon.